Okay, so recently I've talked about how the US dollar is losing value as the Fed is just printing so much of it. But I said during that video that every argument has two sides to it. That's right, even with vast sums of money printing going on, there's an interesting argument which makes the point that the US dollar is actually going to gain strength. So the US dollar will become more valuable, not less. So I asked you in the last video if you wanted to hear that side of the argument too, and many of you commented saying yes. So I read your comments, and in this video, I'm going to present to you Brent Johnson's Dollar Milkshake Theory. So basically, I've scoured the internet, I've edited together these clips where Brent puts forward his argument for why he believes that the dollar will gain strength. And when he starts getting a bit technical, as he does at certain points, I'm going to jump in at the end of these clips to break it all down with a few simple examples that hopefully everyone will be able to understand. And then at the very end, I'll share my conclusion and really share my thoughts on whether I agree with this theory or not. If you appreciate the time and effort it took to put this video together, I'd really appreciate you smashing the like button as it helps with the YouTube algorithm. But anyway, let's get into it and let's kick things off with why Brent believes the dollar will gain in value.
I think that we're going to go through the biggest short squeeze in history. And what I mean by that is I think the US dollar is going to get squeezed much, much higher. And it's going to get squeezed much, much higher because despite the fact that many people don't like it, would prefer to have an alternative, that they just don't. And the rest of the world, the US and the rest of the world has taken out an incredible amount of US dollar debt. That debt either gets paid off, serviced, or defaulted on. And the only way that that isn't extremely dollar positive is if it gets paid off. I don't see how it can get paid off. There's just not enough dollars to go around. But the demand just to continue to service it continues to put a bid under the dollar. And if it gets defaulted on, defaults, while it may decrease demand, it actually destroys money. And what I mean by that is in a debt-based monetary system where money gets loaned into existence, a default actually makes money disappear. And it starts a chain reaction all the way back to the collateral, which was the original basis of which everything was loaned into existence. So even if you have defaults where demand falls, supply falls even faster. So whether people continue using the dollar and are able to service it, I think that puts a bid under it. Or if they start defaulting on it because they can't pay it or don't want to pay it, we get a supply shock and the dollar goes higher. I can't figure out a scenario. Actually, I can figure out a couple potential scenarios where it would go lower, but I just think those are very low level probabilities.
So when it comes to if something is going to rise or fall in value, we always come back to the most simple concept of supply and demand. So I think we're all kind of familiar with the basic idea that if we increase the supply of something, it should push the price down, assuming all else is equal. And if we increase the demand of something, it should push the price up. So when we talk about the Fed printing many dollars, this obviously increases the supply, and that could cause the value of each individual dollar to fall. However, we also have to consider what will happen with the demand side of things. And Brent is making the point that many countries around the world have essentially taken out these loans in US dollars. And that means that they need to make interest payments each and every year in US dollars. So let's say you borrowed $1,000 from the bank. At the end of the year, they might come knocking and demand $30 of interest from you. Now, if you have $30 in your possession, no problem. You can just go and get it and pay them back. But what happens if you don't hold any dollars? Well, you'd have to go out and buy those dollars from the market. Maybe you'd have to sell some stocks, some bonds, some of your possessions, whatever it takes. You have to go out and buy US dollars by essentially selling what you currently have. And that right there, buying those US dollars, is going to increase the demand and potentially increase the price. Now, of course, you going out and buying $30 isn't going to have much effect on the value of the dollar. But let's imagine for a second that it's not just you and it's not just $30. Instead, we're talking about countries, central banks, and trillions of dollars. If all of these countries have to go out and really buy many billions of dollars in order to pay the interest on the loans that they've taken out, we can begin to see how this could increase the demand for dollars. And as a result, it could then feed down to the value of the dollar in a very positive way. Now, you might still be thinking, just because demand for dollars might rise, it doesn't really matter, because if the Fed keeps printing it, eventually the supply is going to increase so much that it overpowers the rising demand. So let's jump back in. And again, this gets a bit technical, but don't worry, I'll break it down for you in simple terms after.
And now everybody's printing. The whole world is printing. We're printing, but this, and then people will say to me, well, isn't this going to kill the dollar? Well, if we were acting in a vacuum, it absolutely would. But this is also very similar to 2009. When we announced QE1 and 2 and 3 back in 10 years ago, a number of institutions and people around the world thought that the United States dollar would fall as a result of that. If you think the dollar is going to fall, one of the smart things to do is you take debt out in that currency, and as it gets inflated away, you pay it back at a lower price later on. Well, the rest of the world borrowed $13 trillion in US dollars. I think it was around 4 or 5 trillion in 2008, and now it's another 10 trillion since then, 9 or 10 trillion since then. But the problem is that the dollar didn't get weaker over that time. The dollar actually got stronger over that time. And so now we're back in the same situation. We owe a lot of debt, but the rest of the world owes 13 trillion of a currency that they can't print. So now you still have this high level of debts that need to be paid off, but the supply of dollars is shrinking. It's deflation, right? And so we're going through a massive deleveraging event right now. And so now all the central banks of the world again are coming out and printing like crazy. And listen, the Fed is printing like a madman. I'm not denying it. But the ECB is too. The Bank of Canada is too. China is too. Australia is too. Brazil is too. Everybody. So now we're back to this coordinated effect again, right? Everybody's providing liquidity. I just happen to believe that it doesn't really matter where that liquidity gets injected. Whoever has the straw gets to suck up that liquidity. Now, on a relative basis, despite the fact that we've cut rates all the way down, they're still basically the highest in the world, other than maybe China. And again, I don't think people are racing to put money into China right now. I don't think the Russian ruble is going to become the world reserve currency anytime soon, right? So while our rates are certainly not as high as they were 2 years ago, on a relative basis, they still look pretty good. But all those other factors are still attractive for capital to come into the United States. And I think the fact that we are still the world reserve currency combined with those other factors will draw capital into the United States over the next couple of years. And I think drawing in that capital will keep the dollar stronger than other fiat currencies, despite that we're printing so much of it.
Okay, so let's break that down as Brent makes a few points there. First off, he acknowledges that the Fed is printing money like crazy, but he also highlights that just about all central banks globally are really doing the same thing. So the US dollar isn't actually that unique in the aspect of the fact that it's being printed like crazy. The next point that Brent makes is about who is going to suck up all of the liquidity. Okay, so what exactly does that mean? Well, if countries are printing large amounts of their currencies, the question is, where does this money go? Who ends up with most of the money? If we imagine a big game of Monopoly, for example, and someone suddenly introduces new money to the game, well, who's going to end up holding most of that new money? And that's kind of like all of the central banks printing money globally. Where's that money going to eventually end up? Well, this is where Brent makes the case that most of the money, in his opinion, is headed towards the United States. He discusses high interest rates, the fact that the US dollar is the world's reserve currency, and at other times has referenced the strength of the US stock market. All of these are key factors for why he believes the US is going to suck up most of this new money, and this will actually make the dollar even stronger. By the way, if you're wondering why the theory has such a unique name, the US Dollar Milkshake Theory, it comes from a film called There Will Be Blood, and it comes back to this concept that because the US is so appealing in the eyes of foreign investors, the US will eventually suck up most of the new money being printed. Now, Brent has also gone on at other times to discuss that he believes this will have a tremendously positive effect on the US stock market. He believes that as the US dollar gains in strength and other currencies around the world lose their relative strength, some countries may have a major currency crisis. So imagine this for a second. Imagine you live in a country with relatively high inflation and a stagnant economy. Now, you could keep your money in your local currency, but with high inflation, you're just guaranteed to lose money with each passing year, so that doesn't look like the best bet. You could invest your money into your country's stock market, but maybe you're not that confident in the stock market, and also you probably can't handle the crazy volatility that could come with it. Or you could invest your money into the US stock market. Now, sure, of course, the US stock market may crash like any stock market, but it's probably going to crash less than your own country's stock market. And the US stock market has generally been on a very consistent upward trend over the past 100 years, so you also have a good chance of actually making some money. In Brent's opinion, this increased demand for US investments from foreign investors will be positive for the US dollar, and as a result, he is one of the few investors around who believes that the US dollar is going to increase at the same time as the stock market. Now, most other analysts, they actually believe that either the dollar will fall, causing the stock market to rise in dollar terms, or the stock market may fall on the back of the dollar gaining in value. Most analysts believe that we could see potentially both going down or one of them going up. There's very few analysts out there that actually think they're both going to increase, but that's what Brent believes with his Dollar Milkshake Theory. Okay, so the theory sounds great, but let's be honest here, there are a lot of theories out there and they often point to opposite arguments while both somehow kind of sounding correct. So if you're feeling confused at this point, don't worry, I'm right there with you. Like I said in the previous video, I was happy to present both sides of the argument, as I think it provides you with a more balanced point of view. But don't expect to hear two sides of an argument and then feel more confident that one of them is correct. As is always the case in life, if you consider the other side too, you might end up slightly more confused during the process, but once you do process everything, you'll end up with a fairer, more balanced perspective at the end, and that is what's most important. And also don't worry, as the conclusion at the end will tie things up quite nicely, and hopefully leave you less confused than you might be at this point. So let's carry on, and Brent will share his thoughts on what would have to go wrong for his theory to not be correct. But most importantly, he's going to talk about what he recommends that we, as investors, should do.
The main problem is that I see this supply-demand imbalance between the dollars that exist and the dollars that are needed. The common challenge to my thesis is that the Fed will provide however many dollars are needed to the rest of the world and to the United States economy. If they end up doing that, then I will be wrong, and I will be wrong on an absolute basis. However, I don't think that that's going to happen, but we'll have to just wait and see. But that's one way I could just be completely and absolutely wrong. The other way I could be wrong is I could just be early, and maybe the dollar sells off over the next 6 to 12 months because of a number of things that the Fed is able to do in the short term, but that they are not able to solve in the long term, and that we end up right back where we are, or we end up right back where we were in March, next March or next July or something like that. And in that case, I will have been early, and the thesis won't have played out yet, but I still have the opportunity to be right in the future. So I could be wrong in the short term, but still be right in the long term. First of all, I'll say that absolutely everybody should own gold. It should be the bedrock of everybody's portfolio. I've said this for years. I continue to believe this. My point is not that you shouldn't own gold. My point is that when it comes down to it, people need to have dollars. They don't need to have gold. They may want to have gold, and I may want to have gold, but to operate on the world stage, you need dollars. And when they had to choose between dollars and gold in March, they chose dollars. Now, after we got through that liquidity squeeze, gold came back faster than anything else, and the miners came back faster than anything else. But when liquidity needs come, dollars are favored. And I'm not convinced that the next time that we need dollars, which I'm sure is coming, that the same thing won't happen again. Now, maybe it won't. Maybe people are going to continue to buy gold and silver, and especially in foreign currencies, not US dollar terms. If I was a Canadian dollar investor or an Australian dollar investor or a yen investor, I would have no qualms about gold right now. And again, if you have a long-term time horizon and you don't mind what gold does on a monthly basis or a weekly basis, then there's no reason not to own gold now.
Okay, so let's break it down. Brent highlights that the main way he could be wrong is if the Fed simply print enough dollars for the rest of the world. If they do this, then it doesn't really matter that countries worldwide need to buy dollars to pay off their debts, because however much the demand for dollars may rise, the supply will simply rise alongside with it. Now, personally, I think there's a good argument that can be made that the US have an incentive to provide dollars to other countries if it means that those countries won't default on the debts that they owe to the US. But to tell you the truth, like I always say in these videos, I'm just a regular guy researching these topics to really try to get my own head around things, and then I'm just sharing my research with you. Even though I'm fascinated with economics and finance, I am not a financial advisor, hence this isn't financial advice, And I'm really no economist. So I think it would be incredibly naive and maybe even slightly arrogant of me to think that I know better than Brent Johnson, a far more successful investor and smarter investor than myself. Instead, what I'll highlight is something that he believes which really resonates with me. He believes that the world's financial system is fundamentally set up in a way which means that it doesn't have a reverse gear. He believes the central banks have simply been kicking the can down the road. So when a recession or a depression comes, the only option they really have is to turn on the printing machine and print currency. And if we believe this to be true, which I personally do, then we start to ask ourselves, which investments look good with this in mind? Well, the main investment that comes to mind for myself and for Brent is, of course, gold. Brent believes that gold could actually see significant growth, potentially reaching as high as $5,000 and maybe even higher as his theory plays out. Now, he also adds the gold may sell off at various times as investors need dollars to be able to play in the international markets. So they may be forced to sell some of their gold for dollars at certain times. But as he adds, if you're a long-term investor, which I don't know about you, but I personally am, then we shouldn't really care what happens on a daily, weekly, or even monthly basis. It's more about the long-term perspective. In fact, as we play this last clip, you'll hear how Brent's theory very interestingly concludes.
And then the dollar. As the dollar goes back to its all-time highs, the world financial system just cannot survive on a strong dollar. It just doesn't function. So something is going to have to be done. And whether it's an overnight revaluation, another coordinated plaza accord type thing, it's going to have to be revalued. And when the dollar starts going down and when they start doing things to weaken it, that's when the U.S. assets will lose value. That's when the stock market will crash. That's when gold's really going to shine. Because the final showdown that everybody's waiting for is definitely going to happen. And it's just like in Highlanders, there can only be one. At the end of the day, gold will beat the dollar. It's the one asset that can't be inflated away. It's the one asset that can't be destroyed in a deflationary collapse. So everybody should own gold, but it doesn't mean it's going to happen tomorrow.
What a great quote. At the end of the day, gold will beat the dollar. So interestingly, even though Brent believes the dollar and the stock market will gain strength in the short term, he also believes that ultimately both are actually headed for a crash. And he adds that gold will beat the dollar. Now he adds that gold is the one asset that can't be inflated away. And to this point, I would actually mention Bitcoin and its permanently fixed supply of 21 million. I think Bitcoin has a place in every investor's portfolio, albeit, to be fair, quite a small place. Don't get me wrong, because it is much newer and much more volatile than gold. But if you simply look at the data from a purely mathematical standpoint, allocating between 1 and 5% of a portfolio to Bitcoin has been shown time and again to increase the risk-adjusted return because it's not highly correlated with any other investment type out there. It goes back to some of the tenets of investing such as modern portfolio theory. So what are the key takeaway points? In Brent's opinion, in the short term, the US dollar is going to gain strength over other national currencies. He believes its role as the world's reserve currency is strong and it isn't going anywhere anytime soon. Again, like I said in the last video, I'm personally not so confident that this is right, but at the same time, he's much smarter than I am. And interestingly, our long-term views are very well aligned. Brent believes that the dollar's strength is mostly in comparison to other national currencies. And at the end of the day, they are all somewhat being inflated away, particularly with so much money printing going on and it likely to not be stopping anytime soon. So in the long term, he believes even the dollar will lose strength in comparison with the likes of gold. Okay, so this is a really interesting theory and I'm keen to hear your thoughts. So let me know in the comments what you think about this theory, whether you agree or whether you disagree. And let me know if you have any suggestions for future videos. In the meantime, check out this video up here for more investing and finance content. And of course, just thank you for watching.